Let's be honest, you've already seen people talking about this Bitcoin drop, but what I want to walk you through right now isn't another repeat of the same headlines. I want to take you into the deeper layer, the layers that actually explain why this happened and what this moment really means. Because this wasn't a typical correction. There was no sudden panic, no oh no, something broken, no rug pull, no catastrophic news. What happened was quieter, deeper, and honestly, more interesting. You ever walk into a room and feel something changed even though everything looks the same? That's what it feels like. Before Bitcoin even made a move, the first tremors appeared in AI stocks and mega cap tech. Nvidia, Apple, Amazon, the giants carries the entire US markets on their shoulders. When those names soften, it's never random. But here's the real twist. Bitcoin react before stock did. And when Bitcoin leads the downside, that's not emotions. That's liquidity. Bitcoin is the fastest asset in the entire financial system. It trades globally 24/7. No circuit breaker, no holidays. It feels liquidity changes before the stock markets even wake up. Think of Bitcoin as the smoke alarm in your house. Stocks are the firefighters. They show up later. Bitcoin is the first loud beep when something wasn't right. And the shift started in a place most people wouldn't even look at. Japan. The Bank of Japan raised interest rates. Sounds simple, right? And not a boring headlines. But raising rates wasn't the story. It was the spark that disrupted a 20-year-old liquidity engine called the yen carry trade. Now let me break this down in a way that makes this crystal clear and easy to visualize. For nearly 2 decades, hedge funds borrow yen at almost 0% interest rate. Imagine paying 0.1% for money and invested into the US at 4 to 5%. That's free profit. And this free money engine quietly pumped trillions of dollars into US markets, stocks, tech, bonds, and yes, Bitcoin exposure through derivatives and ETF. But when Japan raised rates to around 1%, the first meaningful hike in almost a generation, the math didn't just change, it's collapsed. Suddenly, borrowing yens was 5 to 10x more expensive. That flipped the carry trade from risk-free profits to dangerous liability. And when the carry trade unwinds, it does not unwind gently. It unwinds like a guy trying to run down an icy hill, fast, messy, and with a few loud noises. This exact pattern triggered global sell-off back in 1998 and 2007. Both times, money had to rush back to Japan, not because investors wanted to sell, but because the math forced them to. Funds unwind by selling whatever is most liquid, tech, indexes, and Bitcoin, the most liquid global assets on earth. So Bitcoin reacted first, not because it's weak, but because it's fast. Now let's lay in the second conflict, the Federal Reserve. The Fed ended quantitative tightening earlier than expected. Historically, the Fed only stopped QT early when something in the financial plumbing is straining. They did it in 2008 when credit markets froze. They did this in 2019 when repo markets collapsed. They did this in 2020 during the pandemic's liquidity crunch. So when the Fed halted QT this time, institutions recognized the signal. Something, somewhere is stressing the system. Institutions don't wait for confirmation. The risk model flips instantly. And when these models say reduce exposure, they trim assets that are easy to sell, which once again put Bitcoin first in line. Let me pause and give you a real personal take here. Back in the days, I used to think dips were caused by fear, people panicking, dumping their bag, the usual story. But the more I study liquidity, the more I realize that Bitcoin isn't reacting to emotion. Bitcoin reacting to the heartbeat of global finance. Bitcoin get punched earlier, but it also recovers earlier. Once you understand this, you stop panicking on dips and start reading the signal like an analyst. Now here's the third pressure point. Internal Bitcoin tension. Inside Bitcoin community, there's been a debate about what Bitcoin should be. Pure money or money plus inscription and data? This tension affects mining fees, block space, node costs, decentralization, real fundamentals. Some long-term holder didn't like the directions and step aside temporarily. Not a huge percentage, but in a tight liquidities environment, even a small internal selling can amplify external forces. But the biggest conflict, the one shaping this entire moment, is Bitcoin generational liquidities transition. For years, early whales and miners were rich on paper, but trapped in reality. You couldn't sell 10,000 Bitcoin without wrecking the chart. Liquidity was too thin. Exchanges were too small. The markets couldn't handle them. But now, spot ETF, BlackRock, Fidelity, sovereign wealth interests, billions in daily regulated volume. For the first time in Bitcoin history, early holders can responsibly unwind small slices of their stash, not because they're bearish, because they finally have the structural abilities to rebalance. This is exactly how gold transitioned in the 1970s. This is how tech stock transitions after 2000. Early holders contribute, institutions accumulate, the assets becomes global. But transitions like this are messy. They're noisy. They shake out weak hands. They build strong hands. Now let's zoom out, because this is where all the conflicts converge. Global liquidity is reversed for the first time in decades. The Fed's quietly signal hidden stress. Tech giants softened. Internal Bitcoin's debates added friction. And early whales passed the torch to institutions. This wasn't a single cause, it was the perfect storm, a convergence of globals and internal shift happening at the same time. Now, what's the solution? The honest truth? Some of these conflicts don't resolve quickly. Japan liquidity's reversal won't fix itself overnight. The Fed's concern doesn't disappear with one announcement. Early whales distributions continues until handoffs completes. But here what is clear. Bitcoin didn't get weaker. The world around Bitcoin shifted, and Bitcoins reacted first, like it's always does. But here's the reality. Governments are deeper in debt than ever. Fiat is inflating faster than people can save. Central banks are reacting, not solving. And the world is marching toward needing a neutral, borderless, scarce, decentralized asset. Bitcoin hasn't changed. The reasons to own it haven't changed. If anything, the reasons are stronger now. Zoom out. Zoom out, stay steady, and remember, this isn't destruction. This is evolution. If this brought you clarity, make sure you subscribe. I break Bitcoin down with intelligence, honesty, and long-term perspective. And my friend, don't forget to hold it tight and stack it right. Take care.